denominated bonds and betting on devaluation. In July 1997, Thailand was forced to abandon the peg. The baht collapsed 50% in a matter of weeks. The contagion spread. Malaysia, Indonesia, South Korea all saw their currencies collapse 50 to 80%. The hedge funds that had executed Move 1 made billions. Stanley Druckenmiller's Duquesne Fund made over $2 billion in 1997 alone, most of it from the Asian currency crisis. Now in 2026, Move 1 is being executed against the US dollar on a scale that dwarfs all previous examples. China, the largest foreign holder of US treasuries, held over $1.3 trillion in US government bonds in 2013. By 2026, that number has fallen to $720 billion. China has sold over $580 billion in treasuries. This is the bond exit. China understands that the US federal debt, now over $36.5 trillion, is unsustainable. The US will be forced to inflate the debt away, which means devaluing the dollar. China is exiting before the devaluation. Japan, the second largest foreign holder, held over $1.3 trillion in treasuries in 2021. By 2026, Japan holds $1.02 trillion, a reduction of $280 billion. Japan is also executing Move 1. Belgium, a proxy location for Chinese reserves held through offshore vehicles, has reduced treasury holdings by over $120 billion. Switzerland, the banking hub for European wealth, has reduced holdings by $65 billion. Foreign central banks collectively have sold over $1.1 trillion in U.S. treasuries since the peak in 2021. This is not normal portfolio rebalancing. This is Move 1. The smart money is exiting dollar-denominated sovereign bonds, and the pace is accelerating. In 2024 alone, foreign central banks sold $340 billion in treasuries. In the first quarter of 2026, they have sold another $180 billion. The exit is becoming a stampede. Move number 2 is the asset acquisition. Once you have exited the bonds and hold cash, you face a new problem. Cash in a currency that is about to be devalued is not safe. Holding dollars when the dollar is going to fall 30 or 50% means you lose 30 or 50% of your purchasing power. So Move 2 is converting that cash into real, tangible assets. Assets that hold value regardless of currency fluctuations. Foreign real estate, productive farmland, natural resources, companies that generate cash flow, physical assets that cannot be printed by a central bank. In 1971, after France and Germany executed Move 1 and converted dollar bonds to gold, a different group made Move 2. The oil-producing nations of the Middle East, particularly Saudi Arabia, Kuwait, and the UAE, had accumulated enormous dollar reserves from oil exports. When the dollar was devalued in 1971, they realized that holding dollars was dangerous, so they began buying real assets. London real estate became a prime target. Saudi and Kuwaiti investors bought entire neighborhoods in Kensington, Mayfair, and Belgravia. They bought office buildings, shopping centers, luxury hotels. By 1980, Middle Eastern investors owned an estimated $50 billion in London real estate. When the pound and real estate prices rose while the dollar fell, those assets appreciated dramatically in dollar terms. A property bought for $10 million in 1972 was worth $30 million by 1980, a 200% gain, while the dollar had lost purchasing power. The oil sheiks also bought American farmland, thousands of acres in California, Texas, and the Midwest. Land is the ultimate real asset. It produces food, it generates income, and it cannot be devalued by a government printing press. Those farmland purchases in the 1970s are now worth 10 to 20 times what was paid, even after adjusting for inflation. In 1985, after the Plaza Accord, the Japanese executed Move 2 on an unprecedented scale. The Japanese yen had appreciated 100% against the dollar between 1985 and 1988. Japanese companies and investors, holding yen that were suddenly worth twice as much in dollar terms, went on a buying spree. They bought Rockefeller Center in Manhattan for $1.4 billion in 1989. They bought Pebble Beach Golf Course for $841 million in 1990. They bought Columbia Pictures, MCA Universal Studios. They bought office buildings across Los Angeles, New York, and Hawaii. At the peak in 1991, Japanese investors owned over $500 billion in U.S. real estate and companies. These were real assets, productive properties, income-generating businesses. When the dollar eventually stabilized and recovered in the 1990s, many of these assets were sold back to American buyers at profits or held for rental income. Move 2 protected Japanese wealth from dollar devaluation and generated returns.